Hello, welcome to our surprise investment review and outlook video. We try to do these once a quarter, but sometimes when we have a year that started so far, like this has, then we need to record these a little bit sooner. So this is a special recording. I'm doing this on the afternoon of Thursday, March 13th. Hopefully, you guys are seeing this pretty soon afterwards. Um, but again, lots of client questions that have come out in the last couple of weeks, really, and just kind of seeing everything that's going on in the world, in the markets. Thought it would make sense to just have a quick little check-in and make sure everyone understands how this actually affects them. Um, I'm not going to get too far into politics, other than what it actually affects the market and what it does for your portfolio. Happy to talk about any of this. Just reach out. Let me know if you have questions. We can schedule a meeting and talk through what this actually means for you. But let's just jump right into the data and see what's actually happened so far, and we'll kind of talk through a few different charts there. So as I share my screen, we have this is several different investments, things that you can actually invest in, ETFs and things like that in the portfolio. I'm going to go from the best performer year to date to the worst. So the best performer so far this year, as of the morning of the 13th, is gold. So gold is up almost 13% on the year. That is followed by almost 8% is developed international stocks. So if we look at places like Europe, Japan, um, Australia, they've done really well so far to start the year, and they're up almost 8%. So, turn off the news and you might actually see that some investment stuff is actually doing pretty well. Then we have followed by that emerging markets are up 3% this year. That includes China as the biggest one, but we have South Korea, India, Brazil, Eastern Europe is also included in there. And then at 2% is bonds. So bonds have actually performed pretty well so far this year. It's a combination of interest and then also a little bit of interest rate movements, which has been good for bonds. On the downside, the S&P 500 is down about 4.5% so far this year. And that's really led by two areas. And so that's why I highlighted two other pieces here. We have tech stocks, the QQQ, NASDAQ is down 6.7, so worse than the overall market. And then the worst sector to be invested in is consumer discretionary, down almost 12%. So the biggest holdings in consumer discretionary are Amazon, Tesla, Home Depot, McDonald's, Starbucks is in there, Lowe's, Nike. So all of those as a whole have been the worst performer here in the US so far this year, and that's impacted both the NASDAQ and even more so the SP 500 as you look at all that. So not a great start for the US market in particular. But again, if we look around the world and we look outside of just typical US investments, so whether it's bonds, emerging markets, developed international, or commodities, they've all done pretty well so far. And that is what leads to, if you log into your client portal, kind of regardless of your allocation, you're probably right around 0% for the year. We do have a lot of U.S. stocks, but we have all these other things that are built in there as well. If you think back to our changes going into this year, we specifically talked about wanting to reduce the overexposure to the Magnificent Seven, to the large cap U.S. stocks, and we made changes to do that. And I want to point out it happened faster than I expected, but I want to point out kind of what's happened so far this year that's leading to on the news cycle so negative on stocks when it's really driven by the stuff that did really well last year and the year before has underperformed this year. And so my next chart that I have here is year-to-date return for the Magnificent Seven. So just to quickly walk through what those are, we have NVIDIA, Meta, which is Facebook, Apple, Amazon, Microsoft, Alphabet, which is Google, and Tesla. And so you can see across the board, pretty much everything's down in that Magnificent Seven that make up such a large percentage of the market. So the only one that's even up for the year is Facebook, is Meta, up 5.8%. And the worst performer by far is Tesla, down 38%. I want to pull up another chart that goes back a little bit further that actually just shows percent off of the all-time high, because we did have peaks that were earlier. So as you can see here, None of these are anywhere close to their high. The worst one is Tesla down 48%. If I go back to right around the election, really is our starting point here. And you can see um, everything is down quite a bit. And so if you're over invested in something like Nvidia, which was the biggest stock before this drop that you have here, biggest stock in the world ever, that's down 20%. That feels really, really bad. But you are well diversified, and we've actually intentionally skewed away from this. Right here at the beginning, yes, we didn't sell at the top, but reducing some of that exposure, adding a little bit more to international, adding some more to a long short fund and real assets has been actually a really great thing for the portfolio so far, and we want to keep that up. I don't think that these things are anywhere close to fair value yet compared to the rest of the market, and so we don't want to be over invested in any of these, and we want to stay well diversified. One big piece that's happened that's led to the outperformance for international stocks and commodities and gold is the change in the U.S. dollar. So we've talked about this for the last couple of years that the dollar index is an important factor that people overlook a lot. And so there's structural reasons why in the long run the dollar index can't really be above 110 or below 93 to 95. And so this is just comparing the US dollar compared to other investments. And so let me show our chart. This is the last 3 years, and you can see how the dollar has changed over time. So if we go back a little bit, the peak was almost 115, about 114 back in 2022. And then we had a nice drop down closer to that 100 level, which I think is a great level if we were at long term for the dollar on the strength of the dollar compared to other currencies. But you can see how it's oscillated, gone up, gone back down. And then if we go to the beginning of this year, so right around the peak for the dollar was in early January, at least in this cycle, almost 110. And as I said at the onset of this, 110 is kind of a structural limit that we can't sustain above that level too high. Well, this drop in the dollar, drop from 110 to 103, is a pretty big impact because if you own international stocks, which is how we own um, within your mutual funds and ETFs, when you own international stocks, they're priced in the local currency. So not only do we get the benefit of companies making money, but if there's a currency change where the dollar weakens, you actually get better performance in other investments that are priced in other things. So we have this nice tailwind for international stocks, and that's the same thing for commodities. You can kind of think of gold as a currency in a lot of ways, and so when the dollar's weakening, that means relatively gold's doing well, which means gold is hitting all-time highs in when priced in U.S. dollars. And so this is something that we keep track of. It's not really a timing mechanism, but it's something important to be aware of. When the dollar is strengthening in the short run, we expect underperformance for U.S. stocks. When and stocks in general, when the dollar is weakening, it actually is bullish, especially if we're talking international or commodities. But even then, over the long run, we like a weakened dollar. I hate those terms that people use, the weak and the strong dollar. From a U.S. consumer perspective, we like when our dollar's strong because we can buy things from abroad. But from an economic perspective, for the whole uh, country and for stocks and for GDP growth, we actually like a little bit weaker dollar. And in the long run, it's better for economic growth to have a little bit weaker dollar. So with that, I think this is a good development and is part of why we've seen international and commodities have done a little bit better so far this year. So diversifying away from the large cap has helped a lot, and we're going to maintain that. Adding a little bit more to international and commodities and real assets has helped with the portfolios. Not selling out of bonds, even though the return is less, the risk is less as well, and so that's helped so far this year. And then we did add, and I mentioned this before, we added to a long short mutual fund. And that is a nice way to make money kind of regardless of the market. And when you have volatility day after day, that's an important thing to have. And so I want one last chart that I think is important to keep in mind. This is, again, a 3-year chart looking at bond interest rates or treasury interest rates. So let me quickly tell you what you're seeing, and then we'll walk through what this means. So the purple line, that is the 10-year treasury rate. And you can see that right now we're at 4.28%. The orangish line is the 2-year. So what are 2-year bonds earn? That's just under 4%, 3.94. And then the blue line, that is our 10-year tips break even rate. So that's a good proxy for what the market believes inflation is going to be over the next decade. So this is basically how much inflation does it have to have for you to be agnostic between tips and treasuries, so inflation protected securities and treasuries. So what does this all mean? As you can see, the purple line is now above the orange line, but going back, we had what was called an inverted yield curve, where the 2-year was earning more than the 10-year. And that historically has suggested that we might be headed towards a recession. It's not a perfect measurement. Well, now that's flipped. And so that's actually really good. We like that. We believe that there'll be higher economic growth. Some of the reason that's happened, though, is decisions like having tariffs, if they stay around for the long run, that's not going to be good for economic growth. It could lead to inflation. The more inflation that's going to be there, the bigger deal it is for especially the 10-year treasury rate. And so this is just something that we're watching. You can still earn some really good interest on your bonds, but over the last couple of years, we've actually front loaded and had more short term bonds that are maturing 6 months, a year, 2 years out. And now that this yield curve is more normal, where longer term bonds pay more than short term bonds, as we're buying more bonds in the portfolio, we will be extending out our bond ladder a little bit, lock in those better yields. And some of what we will be buying and have already bought for some people is TIPS bonds. So this 2.3% TIPS break even rate is pretty stable, as you can see, over the last 3 years, other than this blip here at the beginning, which that's when inflation was really high. 2.3% is well off the historical long-term average. And if I were to bet which direction this is going to be, is inflation going to be higher or lower than the TIPS break even rate? All the probability points to it's going to come in at a higher rate. And so what that ultimately means is if you can buy some TIPS bonds right now, it's pretty cheap, and inflation protection is still, I would argue, pretty cheap overall. And so with all that in mind, we will be buying some TIPS bonds and other inflation protected type securities. I think I bonds make sense again as well. And we've talked to some people about that. So all this is moving, it's changing, it's something to pay attention to. But as you can tell, I think with just the tone of my voice, it's actually not a bad market. There's some bad stocks, some things that we don't want to overinvest in, but that's where diversification really helps because we have intentionally diversified where you're not overexposed to the Magnificent Seven. So of course you have investments in those and they haven't done well, but you also have bonds and international stocks and commodities and everything else that's built into the portfolio. We are not trying to bet on which specific securities or which specific sectors or large cap versus small cap is going to outperform everything else. We want to invest in things that we want to have for the long run, rebalance as opportunities present themselves, and stay in a diversified portfolio. So as we look ahead, you will see more and more trading as we go throughout this year. We have more volatility than we've experienced really since 2022. And so that leads to me needing to do more on my end. But that doesn't mean we need to panic. And actually, this can be really good opportunities for the market. So uh, I have my concerns as we look long term for the economy and inflation and the political environment that we're in, and all of those things are still concerning to me. But as we're looking from just an investment perspective, still optimistic, still believe we'll end the year probably up. I would actually be surprised if we don't have a new all-time high in the S&P 500 before the end of the year. It could be 6 months from now. I don't think it's going to be a month from now, but if things keep selling off, we're going to buy low. And that's what a long-term investor should do. You, as a reminder, you have nothing in stocks that you need to spend in the next decade. So given that that's the case, we can weather through some volatility, some choppiness in the market, and actually take advantage of opportunities. So again, long-winded answer to say you're going to be okay. And happy to talk about it, how it applies to your specific situation. But overall, from a market perspective, things are not as bad as they look in the news. So, with that, I'll leave you. Let me know if you have questions. Happy to talk at any time.